According to one of the world's biggest hedge funds, this one chart is the smoking gun. And it's their indicator that this whole AI craze is one big bubble.
Now, what we're seeing here isn't an AI stock. It's Oracle's credit default swaps, insurance on the amount of money that they're borrowing. And it's spiking to levels we haven't seen in years.
So the question is, does this chart signify the great unwind? Or is Wall Street kind of misreading things about the greatest innovation of our generation?
AI. No company would be immune if the current high valuation of AI tech firms turns out to be a bubble and bursts.
If this bubble bursts, the risk is global financial system meltdown. If those companies fail, then the global economy goes to shit.
This podcast is for educational purposes only and is not intended to be financial product advice or any investment recommendation. Stay tuned for additional disclaimers at the end of the episode.
Okay, so what we're focusing on here are credit default swaps, and this is what people can see now, right? This chart is showing the spread on Oracle's CDS, their credit default swaps. Now that is basically insurance on their credit rating, right? And what it's showing here is that the cost to insure the amount of money Oracle is borrowing to fund its AI capex is rising.
Pretty much, you know, it's effectively as you just said. Whenever you see something in credit or credit spreads sort of blow out is what the common term is when spreads blow out. That is what's being shown is you know, the insurance costs are indeed rising. Now, there's two things that I will say about this. One, this is also reflected in Oracle's equity price. Okay, so they're about 45% down year to date, which is pretty big. However, their run up over the last 5 years has been massive. Yeah. And so I think this could potentially just be more of a reflection of their equity price and their share price than anything else. However, there is always, you know, that case to be made that, of course, for a company like Oracle, to what extent are they really going to be able to grasp the AI trend and take all of the productivity gains out? Personally, I have no idea what Oracle actually does. But at the same time, they're not a consumer-facing brand. They're not a consumer-facing company. They are pretty much B2B, right?
Yeah.
And so with regards to why their share price is down, don't really have an answer for you.
Let's strip this back as to why we're talking about credit default swaps. People will hear credit default swaps and instantly shoot back to 2008, right? And the financial crisis.
Yeah.
Now, the reason we're talking about this is because of another bubble. In 2008, we were talking about subprime mortgage bubble and the housing market bubble. Now we're talking about the AI bubble. Now, for the last few weeks, or last 2 weeks or so, stock markets have been all over the place. We've seen big sell-offs in the S&P, which have kind of come back to a certain degree, not to just paint one story, but all because of this hyper evaluation of, or over evaluation of AI stocks. Now that's the headline, which is grabbing everything. Oracle's CDS has become the kind of poster boy for AI debt, right?
That's why Bloomberg's reported on it.
That's why Bloomberg's reported on it, exactly that. So when we look at this, I suppose the initial question that I need to ask you on this is AI a bubble?
Well, Jerome Powell mentioned the disparity between the Dotcom boom and this current AI boom. And he said, during the Dotcom, these firms weren't actually making any money. Pets.com, you know, their IPO raised, I think, $85 million.
Yeah.
Million, with an M for mother.
Pocket change.
Which is nothing. And their revenue was like 3.89 million for the next year.
Yeah.
Nvidia just reported quarterly earnings of 58 billion quarterly.
Yeah.
With a B.
And Pets.com had no market cap.
Pretty much $85 million like in 2000 or 1999, I can't remember exactly. But we're talking about two completely different things. You know, the companies these days that are leading the AI charge aren't AI companies. It's tangential to their business. The AI part of it, apart from Nvidia, of course, I'd say, the AI part of it is actually just going to aid them to do the rest of their business processes. That's the bit that we need to focus on. I've said it before. So many people focus on the consumer element of AI and not the productivity gains to businesses.
What, you mean AI isn't ChatGPT?
Yeah, exactly. That's basically what I'm suggesting. I think even just yesterday or today, ABN AMRO, the bank, has let go about 3,000 people because they found AI gains. Mm-hmm. That is real productivity gains. Mm-hmm. And unfortunately, yes, people are going to be unemployed. And we've seen jolts, so the job openings, that's been falling as the S&P 500 has been rising, which sort of proves this. We're seeing operational expenditures decrease, although CapEx spending is going up because firms are seeing their margins increase.
But those savings aren't one and the same. It's not like they're saving money on operational costs because of AI, and with those savings, we're funding CapEx. It's like we're saving this, we're spending trillions of dollars on growth. Now, my problem with this is going back to what you said. Dotcom was a bubble, right? And it did burst. Mm-hmm. But fundamentally, yes, the stock market fell, and yes, there was an issue within that, but it didn't cause anything greater going forward. My point behind this is that if this bubble bursts, the risk is global financial system meltdown, not the Dow off 1,000 points for a couple of days. Because we're looking at the 7 biggest companies in the world, pretty much. Mm. And if they fail, if those companies fail, then the global economy goes to shit.
But how could they be failing when they're making billions per quarter?
We're not saying they're failing now, are we? What we're saying within this is we're saying the cost to ensure the CapEx is going up, right? Because this CapEx is mad. And it's absolutely huge spending. So JP Morgan expects it to be by the end of next year, north of $1.5 trillion in spending from 7 companies, not just those 7 companies, but on AI going forward. So the cost of that keeps going. That was the initial issue in the subprime mortgage situation, right? The initial problem was that the cost to insure debt for Fannie Mae, Freddie Mac went up, right? Because it was because it was more risky, not the same situation, but the same thing happened, right? So in that scenario, I suppose the question is that scenario the same as this scenario?
No, because I'd say what you'd have to look at is, okay, are we classed? So if we were to compare it to 2008, you'd have to say, is this basket of debt, of which Oracle is a equal part of, but then you've got loads of really, really small cap, micro cap AI companies also in there.
Junk AI companies.
Yes. If they're all included in that basket, which with Oracle's CDS, it's not, it's just on Oracle
It's just
debt,
Oracle, yeah.
Then we could maybe make the comparison with 2008 and, that asymmetry of information, which regulators, they priced the CDOs at AAA when they were actually, literally junk.
Yeah.
But people were buying them on the basis of them being AAA. And then, yes, Goldman was running CDS on things that they were just selling. But I don't think the opacity of information is there. We know what Oracle's...
So we just don't know that this is not happening with AI at the moment. We just don't know if that's not happening.
But we do know, because we know it's only on Oracle's debt.
No, we know that this is only going on, this spike is only happening on Oracle's debt at the moment. The issue around the 2008 crisis, right, was that actually behind the scenes, there were synthetic CDOs that were being created, right? Mm-hmm. And everyone was betting on different forms of this, right? And one going bust and non going bust and blah, 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 blah. And it was $50 trillion on, there was $1.5 trillion of risk. And actually on the synthetic side, there was $50 trillion worth of risk, right? But it wasn't all visible, right? No. Didn't know. Same thing, same situation. I'm not saying it's happening now, but is there not a risk because of the amount of CapEx going on in the AI? Now, I'm not saying it's the same scale. I'm not saying this is the same scale as the US housing market, But what I'm saying is there not the risk that as this debt increases, which it will, of course, it's not going to stop. So the capex is going to grow. Other companies will be made. AI companies will be made. They're happening all the time, right? New companies, junk companies, whatever. But they're all borrowing to make up this, to invest in AI future. Now, who is to say, or who is to stop this all being bundled together? Put in something like synthetic CDOs, which are called completely different things these days, right? What is to say that as this grows, as it will, that doesn't move forward, that doesn't happen going forward? This debt, as it becomes bigger, gets put and sold and put in tranches, and it fails.
I don't know if it would matter in the same way, because what would, I think, happen in that case is that the debt would be converted to equity. And so that is largely what would happen. Obviously, it depends on the seniority of debt as well.
Yeah.
So junior bondholders would be wiped out. But largely there's probably covenants in there that say it's convertible to equity, is what I'd say, which means that obviously then they'd effectively become shareholders.
Yeah, but then if these things start to fail, it means the equity in these companies, the larger companies, the Nvidias, the Mag 7, means the equity starts to fall.
Potentially, but only if they sell. Only if they go and sell.
My point is that as this grows, it becomes a beast which can get out of control. And if AI isn't the all-seeing eye that we all expect it to be, then the global economy has a problem. And if this does fail, it is a third of the US stock market.
Yeah, I guess you could price that risk for anything. You know, I think at the end of the day, why the revenue side of things is so important for me is because as long as revenues are maintained, and also, you know, they are diversified businesses, they're not just AI businesses. As long as that revenue is maintained, the debt interest can be paid back.
So they all need to be making money in other areas, right?
Yeah.
But if the debt is so high on the AI side, it doesn't necessarily matter.
I'd say it does, because you can cut the OPEX and CAPEX in this way can be cut relatively easily. You know, you can cancel some orders or a large amount of orders relatively simply. It's a little bit harder to get rid of 5,000 people, which is a much more longer term cost, I guess.
Mm-hmm. There's definitely jitters within this market, and they're not going away at the moment. What stops this? What stops the fears coming in? Because recently we've seen markets up, markets down, markets up, markets down. One day a story about it being good, next day a story of Nvidia's earnings coming out, right? So, and it kind of leads us on to some of the charts we've got here. But what stops these fears around AI? Or is this just a byproduct of a booming industry that everybody will always call it a bubble?
I think it is definitely a byproduct of a booming industry. We are at some point going to see a downtick in the market. It happens no matter what. But I think what we're seeing now is what AI is bringing to the world is actually infrastructure changes as well. So we're seeing new data centers being built. We're seeing a ton of new energy creation coming. Mm-hmm. You know, we're seeing even new towns being built to suffice anything near these mega data centers. You know, if you look at Nvidia here, their revenue per employee from 2023 to 2024 increased by 100%, 99.88%. And even from 2024 to 2025, it increased 76%. So
in simple terms, this shows as the company grows, it makes more money.
Yeah.
Fundamentally. So it shows that its recent capex works. Mm-hmm. And that's still all been in AI.
Yep. Absolutely.
So there's nothing to worry about.
There's
always a risk, right? There's always a fundamental risk.
Yeah, exactly. I mean, that's the thing that you have to look for. I mean, last week even I de-risked some positions purely because I didn't understand what happened on Thursday with the VIX spike. It didn't make any sense to me. It went from, I think it was 20 to 28.5 in 4 hours, and that was just very, very strange to me.
Yeah, and we can see the S&P fall for November here. So that's showing I mean, very simply, just showing the downside. Right?
Exactly. And so I de-risked, because I didn't know, okay, well, has someone blown up? What's going on? But then this week, coming into this week, Nvidia's back above some certain momentum metrics. I got long one of my defense stocks that I love just yesterday.
Yeah.
And things are not necessarily looking rosy, but you got to take a punt sometimes.
Yeah. And Nvidia's not exactly a punt, is it?
Well, no, it's the biggest. It's what, $5.1 trillion.
See, and this is, I suppose, the thing. Now we did see their earnings, right? So their earnings were last week, and Nvidia's earnings revenue smashed it out the park.
Yeah.
The revenues are all on GPUs, right? Still gaming. Gaming is, as of their recent earnings, gaming is their fundamental business. All of their forward guidance is AI.
Yeah.
So that's a shift.
But I think largely that's because of the
And the shift is a risk.
the Blackwell chip.
Yeah.
That's why. So the Blackwell chip is full out till Q1 2026 in terms of the order book.
Yeah.
So there's a very, very stacked order book. And then
Explain to us what this Blackwell chip is.
it's just a super fast chip that can do loads of stuff.
Yeah, it's their newest bit of tech,
Yeah,
right?
exactly. It's, they've. I don't know if it's the H100 or if Blackwell is a different one to the H100. But you know, it's the next big thing that's going to power more and more AI. And look, even now, more recently, we've seen the memory companies start to get a lift. SanDisk, Seagate, because they're now demanding memory, which is showing the shift really, really quickly in terms of what they actually require and how advanced these things are getting. Gemini 3.0 just released on, it was either Sunday or Saturday or
weekend.
Over the weekend. That is unbelievable. And the interesting thing about Google now is they are full stack.
Yeah.
So if you actually want
data centers, everything.
Data centers, front end for consumers, and also for businesses and for developers, it's probably better than Claude now for coding. You've also got obviously their massive revenue from advertising, which insulates them largely from some of the downsides. Gmail, they're already integrated with so many businesses. They are possibly, considering the language that was coming out maybe a year or two ago about Google, you know, being behind the curve and all of this, I reckon they could be huge, huge, huge over the next 5 years.
So answer me this question. Out of the Mag 7 stocks, who is not well placed in the AI world? Now, I've heard a lot of rumblings that obviously Apple is not placed well in this area, is not placed well from an AI perspective, not when you consider who it's up against.
I'd agree right now, but interestingly, on the plane over today to record this, I had a weird gut feeling that soon Apple is going to launch something that is going to change a lot. And I have a feeling it's going to be in robotics, which is obviously directly connected to AI. And I don't think it's going to be something that they release soon, but I feel like there's going to be murmurs over the next coming months that Apple's going to do something absolutely insane. Because they can't, in this environment, still be doing the same balance sheet tricks that Tim Cook has been doing with buying shares and things like that. They need to come out with a proper innovation now, not some goggles that was a bit of a gimmick. And I feel like they've got it in them because they've got so much money. They've got so much money sitting there, more than some countries.
There's in fact no AI chatter from Apple. Nothing.
They're integrating Gemini.
So they're integrating Google into all Apple devices. Because what did they release? What was their AI thing called? I can't even remember what it's called. It wasn't just Siri.
Intelligent.
It was Apple Intelligence.
Intelligence,
which is dead. Doesn't do anything.
I've never used it.
No one's ever used it.
No.
Right? And in fact, Apple Intelligence asks you if you want to use ChatGPT as soon as you ask it anything. To answer the question that I asked myself, is it Apple? Are Apple at risk?
Right now, yes. However, again, you can't count out the revenues that they print and the amount of money they have. They've got so much money they can invest it in one go and just become top. Meta are actually very, very lucky that they aren't slipping further right now.
But their CapEx is mental on AI, on data centers, because they're trying to go the same way as Google and be a one-stop solution.
They're spending a lot, and I don't really see why necessarily right now. I think Mark has obviously a very massive ego, even though he likes to hide it.
But there was a news story the other day that they're going to use Google chips rather than
everyone's using
chips.
Google. Yeah. It's an interesting time, and how all these things are connected together is very, very interesting. But I think coming back to making everything simple is how much money are these firms making? That's the only thing that drives the share price.
So there you go. Is AI a bubble? Potentially, potentially not. Which of these stocks does Apple fall out of the Mag 7 because it's not best placed for AI? Let us know what you think. Let us know your opinion on that. Like, subscribe, and we'll see you next time.
This podcast is for educational purposes only and is not intended to be financial, product advice, or any investment recommendation. It has been prepared without taking your objectives, financial situation, and needs into account. Any references to past performance and forecasts are not reliable indicators of future results. For more information, visit axi.com.